Welcome to the program You Can Beat the Stock Market. Here we show you how you can beat the stock market, even though you're not a pro like Warren Buffett. I am Francisco, and in today's video we will explore the origins of the fear of underperforming compared to the S&P 500, its impact on investment strategies, and how investors can overcome it to build a successful, personalized investment approach. Make sure to like, comment, and subscribe for more content like this. In the world of investing, the fear of underperforming compared to the S&P 500 is a common anxiety that can influence the decisions of both amateur and professional investors. As an important benchmark for performance, the S&P 500 often casts a long shadow on investors' portfolios, causing them to constantly compare their results to this market barometer. Understanding the fear of underperforming compared to the S&P 500 is crucial for investors for several reasons. Investors who constantly compare their investment performance to the S&P 500 may develop unrealistic expectations about the returns they can achieve. Recognizing that consistently outperforming the market is challenging, even for professional fund managers, helps investors maintain a more balanced approach to investing. By focusing on the fear of underperformance, investors can ensure their investment strategies align with their financial goals, risk tolerance, and time horizon. This alignment is essential for long-term financial success and can help investors avoid making impulsive decisions based on short-term market fluctuations. The fear of underperforming can generate stress, anxiety, and dissatisfaction with one's investment performance. Understanding the causes and consequences of this fear can help investors manage their emotions, maintain a long-term perspective, and make more rational decisions about their portfolios. Understanding the fear of underperforming helps investors focus on the factors they can control, such as fees, taxes, and portfolio rebalancing. Concentrating on these controllable elements can improve overall investment performance and help investors avoid getting caught up in the performance comparison trap. Recognizing the fear of underperforming can encourage investors to prioritize diversification in their portfolios. Diversifying investment across various asset classes, sectors, and geographical regions can reduce risk, enhance long-term returns, and provide a more balanced comparison to benchmark indices like the S&P 500. And provide a more balanced comparison to benchmark indices like the S&P 500. Understanding the fear of underperformance can help investors develop personalized investment strategies that focus on achieving their unique financial objectives rather than merely trying to beat a benchmark index. This personalization can lead to more powerful long-term outcomes and a greater sense of satisfaction with one's investment performance. Investors who understand the fear of underperforming and its implications are more likely to adopt long-term investment strategies, maintain patience and discipline, and avoid making impulsive decisions based on short-term market movements. This long-term focus is crucial for achieving sustained financial success and building wealth over time. Understanding the fear of underperforming compared to the S&P 500 enables investors to develop more realistic expectations, align their investment strategies with their unique objectives, and focus on the factors they can control. By doing so, they can manage their emotions, prioritize diversification, and adopt a long-term investment perspective that ultimately leads to greater financial success. The S&P 500 or Standard & Poor's 500 index is a market capitalization weighted index of 500 leading publicly traded companies in the United States. It is widely regarded as the best single gauge of the US equity market and is used by many investors as a benchmark for their own investment performance. The S&P 500 serves as a common benchmark for investment performance, allowing investors to compare their returns to the broader market. Many actively managed mutual funds and investment advisors use the S&P 500 as a yardstick to gauge their success in picking stocks and managing portfolios. The S&P 500 has become a popular basis for passive investment strategies, such as index funds and exchange traded funds. These investment vehicles aim to replicate the performance of the index by holding a portfolio of stocks that mirrors the composition of the S&P 500, offering investors a low-cost and diversified exposure to the US equity market. Several factors contribute to the fear of underperforming the S&P 500 among investors. Investors often compare their investment performance to that of their peers or to well-known benchmarks like the S&P 500. This social comparison can create a sense of competition and pressure to outperform, leading to the fear of underperformance. The financial media often emphasizes the importance of beating the market and highlights the performance of indices like the S&P 500. This focus on market beating returns can create unrealistic expectations and exacerbate the fear of underperformance among investors. The growing popularity of passive investing through index funds and ETFs has made it increasingly common for investors to use indices like the S&P 500 as a yardstick for their investment performance. As a result, underperforming the benchmark can feel like a failure or a sign of a poor investment decisions. Passive investing is an investment strategy that seeks to replicate the performance of a specific market index, such as the S&P 500, by holding a diversified portfolio of stocks that mirror the index composition. This approach typically involves lower fees and expenses than active investing, which attempts to outperform the market through stock selection and portfolio management. The popularity of passive investing has grown significantly in recent years, with assets in index funds and ETFs surpassing those in actively managed funds. This shift has been driven by several factors, including the lower costs, greater tax efficiency, and the consistent underperformance of many active managers. The rise of passive investing has also led to increased media coverage and public awareness of index-based investment strategies. This heightened visibility has contributed to the perception that the S&P 500 is the gold standard for investment performance, fueling the fear of underperforming among investors. Many investors are susceptible to chasing past performance, believing that high-performing assets or funds will continue to outperform in the future. This mentality can lead to a constant comparison of investment returns to benchmarks like the S&P 500, fueling the fear of underperformance. Performance chasing mentality refers to the tendency of investors to pursue investments that have recently delivered high returns, with the expectation that these investments will continue to outperform in the future. This behavior can be driven by a combination of cognitive biases, emotional responses, and a desire to maximize investment returns. Several factors contribute to performance chasing mentality among investors. Recency bias is a cognitive bias that leads investors to place more weight on recent events or trends than on historical data. As a result, they may be more inclined to invest in assets that have recently outperformed, believing that their strong performance will persist. Investors may feel compelled to follow the crowd and invest in popular or high performing assets to avoid missing out on potential gains. This herd mentality can lead to performance chasing behavior, as investors seek to emulate the success of others. The fear of missing out on potential gains can drive investors to chase after high performing investments, even when doing so may not align with their long term financial goals or risk tolerance. Overconfidence in one's ability to identify winning investments or time the market can contribute to performance chasing behavior. Investors may believe they can consistently select outperforming assets, leading them to pursue recent high performers with the expectation of continued success. Confirmation bias is the tendency to seek out information that confirms one's existing beliefs while ignoring contradictory evidence. Investors experiencing confirmation bias may focus on the positive aspects of high performing investments while downplaying or ignoring potential risks, further fueling performance chasing behavior. Anchoring is a cognitive bias that causes investors to rely too heavily on an initial piece of information, the anchor, when making decisions. In the context of performance chasing, investors may anchor their expectations of future returns on recent high performing assets, leading them to pursue these investments even when it may not be rational to do so. Performance chasing mentality can be detrimental to long term investment success for several reasons. Chasing high performing investments can lead to an overly concentrated or poorly diversified portfolio, increasing overall investment risk and the potential for significant losses. Performance chasing behavior may result in frequent trading, which can lead to increased transaction costs, taxes, and potentially higher fees associated with actively managed funds. Successfully timing the market is notoriously difficult, and investors who chase performance may end up buying high and selling low, resulting in suboptimal returns. Focusing on short term performance rather than long term financial goals can lead investors to make impulsive decisions that do not align with their risk tolerance or overall investment strategy. To mitigate the risks associated with performance chasing mentality, investors should focus on maintaining a diversified portfolio, setting realistic expectations, and adhering to a disciplined long term investment strategy that aligns with their individual financial goals and risk tolerance. Overconfidence in one's investment abilities can lead to the belief that consistently outperforming the market is achievable. Additionally, cognitive biases such as confirmation bias and recency bias can cause investors to place undue weight on recent market trends on their own investment experiences, heightening the fear of underperformance. Investors may not fully understand their investment objectives or how their portfolio should be structured to achieve those goals. This lack of clarity can cause them to fixate on benchmark performance as a measure of success, instead of focusing on their unique financial goals and risk tolerance. Some investors may believe they have more control over their investment outcomes than they actually do. This illusion of control can lead to an overemphasis on outperforming the market and a heightened fear of underperformance when faced with market volatility or unexpected events. Understanding these causes of the fear of underperforming the S&P 500 can help investors manage their emotions, maintain a long-term perspective, and focus on their individual financial goals and risk tolerance rather than obsessing over benchmark comparisons. The investing world is often driven by competition and comparison, with investors seeking to outperform their peers and prove their prowess in the market. This competitive mindset can exacerbate the fear of underperforming the S&P 500, as investors may feel inadequate if their portfolio does not keep pace with the index. Many investors believe that they possess the skill and knowledge necessary to consistently outperform the market. This overconfidence can lead to disappointment and anxiety when their investment performance fails to meet their expectations, particularly in comparison to the S&P 500. The pursuit of market-beating returns is a common goal among investors, driven by the desire for financial success and the satisfaction of outperforming a widely recognized benchmark. However, this focus on outperformance can create unrealistic expectations and increase the pressure to keep up with the S&P 500. Financial media often focuses on the most successful investors and their market beating strategies, creating a skewed perception of what is achievable for the average investor. This sensationalism can contribute to the fear of underperformance, as investors may feel that they're not living up to the success stories they see in the media. Financial media trends to emphasize short term investment performance, which can create a false sense of urgency and promote a short term mindset among investors. This focus on short-term results can exacerbate the fear of underperforming the S&P 500, as investors may feel pressured to achieve immediate success in the market. Many financial media outlets promote active management strategies, suggesting that investors can consistently outperform the market through skill and expertise. This promotion of active management can heighten the fear of underperformance, as it creates the impression that underperforming the S&P 500 is a sign of a failure or incompetence. A significant body of research has shown that the majority of actively managed funds consistently underperform their benchmark indices, such as the S&P 500. This underperformance can be attributed to various factors, including management fees, trading costs, and the difficulty of consistently identifying market-beating investment opportunities. Several factors contribute to the underperformance of active management, including high fees and expenses. Actively managed funds typically charge higher fees and expenses than passive investment vehicles, which can significantly erode returns over time. The efficient market hypothesis posits that all publicly available information is already reflected in stock prices, making it difficult for active managers to consistently identify mispriced securities and generate excess returns. The success of active management often depends on the skill of the portfolio manager and the timing of their investment decisions. However, it is challenging to consistently identify skilled managers, and even the most talented investors can be subject to the vagaries of luck and market conditions. One of the primary reasons for the underperformance of actively managed funds is the impact of fees and expenses. High management fees, trading costs, and other expenses can significantly diminish the returns generated by an active portfolio, making it difficult for these funds to consistently outperform their benchmark indices, such as the S&P 500. When comparing investment performance to the S&P 500, it's essential to ensure that the comparison is fair and relevant. For example, comparing a diversified global portfolio to a US-centric index like the S&P 500 may not provide an accurate assessment of performance. Investors should consider using benchmarks that align with their investment strategy and asset allocation to make meaningful comparisons. Benchmark indices like the S&P 500 do not account for an individual investor's risk tolerance or specific investment goals. Investors should remember that their personal financial objectives, time horizon, and risk profile should be the primary drivers of their investment strategy, rather than a singular focus on outperforming a specific benchmark. While the S&P 500 is a well-diversified index, it primarily represents large-cap US stocks. Investors should not overlook the importance of diversifying their portfolios across various asset classes, sectors, and geographical regions to reduce risk and potentially enhance long term results. Focusing solely on outperforming the S&P 500 may lead to an overly concentrated portfolio that lacks the benefits of diversification. Investors should recognize that consistently outperforming the S&P 500 through active management is a challenging endeavor. Accepting the reality of active management limitations can help alleviate the fear of underperformance and promote a more balanced approach to investing. Focusing on long term investment performance rather than shortcut fluctuations can help reduce the anxiety associated with underperforming the S&P 500. A long term perspective allows investors to recognize that market fluctuations are a natural part of the investment process and that short term underperformance does not necessarily indicate a flawed strategy. Embracing the concept of market efficiency can help investors come to terms with the fact that consistently outperforming the market is a difficult, if not impossible, task. Recognizing the inherent challenges in beating the market can alleviate the pressure to outperform the S&P 500 and encourage a more realistic approach to investing. Investors should focus on creating an investment strategy that aligns with their unique financial goals, time horizon, and risk tolerance. This personalized approach can help shift the focus away from benchmark comparisons and towards achieving individual objectives. To build a robust and well rounded investment portfolio, investors should consider diversifying beyond the S&P 500 by incorporating other asset classes, sectors, and geographical regions. This diversification can help mitigate risk and potentially enhance long term returns, while reducing the reliance on a single benchmark for performance evaluation. A core satellite investment strategy involves allocating a significant portion of the portfolio to passive investments that track broad market indices, such as the S&P 500, while dedicating a smaller portion to actively managed or specialized investments. This approach can offer a balanced blend of cost efficiency, diversification, and the potential for market performance. One of the most effective ways to improve investment performance is to minimize fees and expenses. Investors should consider low cost investment vehicles, such as index funds and ETFs, and be mindful of trading costs and tax implications to help enhance net returns. Regularly rebalancing the portfolio to maintain the desired asset allocation can help manage risk and ensure that the investment strategy remains aligned with the investor's goals and risk tolerance. Periodic rebalancing can also potentially enhance returns by systematically selling high and buying low. Implementing tax efficient investment strategies can help investors maximize their after tax returns. This may involve considering tax advantaged accounts such as IRAs and 401ks, as well as tax efficient investment vehicles like municipal bonds and index funds. Financial experts often emphasize the importance of focusing on individual financial goals and risk tolerance rather than obsessing over benchmark comparisons. They may also highlight the benefits of a long term investment perspective and the importance of maintaining realistic expectations. Experts may recommend strategies for managing the fear of underperformance, such as diversifying the portfolio, focusing on what can be controlled, like taxes and fees, and adopting a core satellite investment approach. Financial professionals often stress the importance of a long term investment horizon, patience, and discipline in achieving financial success. They may also advocate for maintaining a diversified portfolio and adhering to a well defined investment strategy. Successful investors often employ a disciplined and consistent investment approach, focusing on long term performance and adhering to their individual goals and risk tolerance. They may also prioritize diversification, cost management, and tax efficiency in their investment strategies. Even successful investors may experience periods of underperformance relative to the S&P 500 or other benchmarks. These case studies can offer valuable insights into how they navigated these challenges, adapted their strategies, and maintained a long-term focus on their investment goals. Successful investors often emphasize the importance of maintaining a clear understanding of their investment objectives and risk tolerance, as well as the value of patience and perseverance in achieving long term success. By focusing on these factors, they can overcome the fear of underperformance and build a resilient investment strategy. The fear of underperforming the S&P 500 is a common concern for many investors, driven by the competitive nature of the investing world, the rise of passive investing, and the influence of the financial media. However, it's essential to recognize the limitations of benchmark comparisons, the challenges of active management, and the importance of focusing on individual financial goals and risk tolerance. By adopting a personalized investment strategy that aligns with your unique objectives, maintaining a long term perspective, and focusing on what you can control, you can overcome the fear of underperforming and build a successful, well diversified investment portfolio. Embracing expert advice, learning from the experiences of successful investors, and continually reassessing your investment approach will help ensure that you maintain on track to achieve your financial goals and navigate the complex world of investing with confidence.